Hi traders, hi investors, this is Sal for SLTG. I'm doing here an intraday video, midday in California, but it's there's about an hour left in the market trading session. And I just want to cover the 30-year bond, actually many of the bonds. What I'm showing here is the 30-year bond. It's actually down a little over 1% right now. And it's the move it's had lately has been somewhat extended because what it and by extended, I don't mean today or yesterday's move. I mean the move from 30-year bonds at 118 moving all the way to 126. If I jump over to the TLT, it'll also show the big move from the ETF from the 90 to the high 97s, almost 98. It actually made lower lows today, so that should be quite significant. I'm going to jump over to the IEF, the ETF for the 10-year. Also looks like it rejected the 98 level on the TLT, so easily could pull back. Here's a futures contract. They're pulling back as well, of course. S&P could also be the catalyst because as people shift, maybe if they had bonds, sell bonds. We still have Greece concerns. They're comparing Greece to the U.S., but the S&P is quote-unquote due for a bounce. So what we're seeing right now is people are getting drawn to the stocks, and that is also met with selling in the bonds. So just a simple stocks to bonds ratio. I don't think bonds are that horrible. The rates should increase. I think stocks are worse as far as the variability. So you have to watch out. For the bonds, selling calls may not be as attractive as buying put spreads. The risk of people jumping back into the bonds is higher than if you bought a simple put spread. If you buy a put spread, you could easily you can cap your risk, buy a put, sell a put months out. Limit your risk as much as possible because you can see these big spikes in the bonds. I just zoomed out real quick. If you sell a call, the most you can go out there is maybe September, December, and you're not going to get very far enough to sell some out of it. You can, but if it really moves up, it can double, triple against you because the volatility is not very rich. So that's what I'm concerned about. I'd rather look at maybe buying put spreads and just hitting a moving average, seeing how much there is in there, and maybe you can see continued selling in there, depending on how they trade in the next few days. They are somewhat extended as far as overbought. You have stochastic divergence, so if the indicator breaks down because there's volume selling, then you'll see a continued move. But I just can't foresee how much of that move will happen this early in that move. Let me just jump back to the S&P. If the S&P rises, excuse me, and bumps its head in this 1316 level, you could see buyers step back into the bonds. If the S&P starts to go higher than that, then they'll push the bonds even further. But we're too close to the lows in March to say it's just up. So still continue to be nervous. That's why I prefer buying put spreads versus selling naked calls. And last, I'll leave you with the 30-year yield. 30-year yield was in the low 4s, is now in, let's say, 4.3 level, but it's risen sharply. It's in the past 2 days, so you can see where the first target would be on the yield. And if we do have inflation, the 30-year bond is will their attack, and we've seen them attack or increase the 30-year yield more than they increase the 10-year yield, because we need that 10-year yield for housing. So I may have gone a little fast. Rewind this and go over anything. I just thought this was a lot of interesting stuff that I thought I'd try to pack into a video here. Take care, be safe, and if you have any questions, any specific questions, we'll get you specific answers. Take care.